Welcome to the video lecture series of Project Development and Resource Management. Course code MCA 301, Contact Hour 4, Credit 4. This is lecture 15. Myself, Dr. Shunipa Roy, Head of the Department, Electronics and Communication Engineering, Guru Nanak Institute of Technology, Kolkata. Today, we will cover Module 3. Module 3 consists of cost classification, fixed cost, variable cost, semi-variable cost, cost of capital, capital budgeting, master budget, concept of taxes, direct and indirect tax. So here we will study or learn direct tax and indirect tax. Though in our earlier lecture, we have learned what is direct tax and indirect tax, but in this lecture we will learn some more thing that was not covered in the previous lecture. So the content is this taxation, public finance, public revenue, objectives of taxation, objective classification of taxation, individual income tax rates in India, exemption and deduction from tax, and conclusion. So what is tax? The most important source of revenue of the government is tax. And the tax is the act of levying taxes is called taxation. So tax is a noun and taxation is also a noun. A tax is a compulsory charge or fees imposed by government on individuals or corporations. The persons who are taxed have to pay the taxes irrespective of any corresponding return from the goods or services by the government. And the taxes may be imposed on the income and also in wealth of persons or corporations, and the rate of taxes may vary depending on the slab of income. So what is public finance? Public finance is the study of the role of the government in the economy. It is the branch of economics that assesses the government revenue and government expenditure of the public authorities and the adjustment of one or the other to achieve desirable effects and avoid undesirable ones. So public finance is actually the branch of knowledge which is concerned with the income and expenditure of public authorities with the adjustment of one to another. It deals with the study of revenue and expenditure of the government at the center, state and local bodies. So public finance, as the name suggests, that doesn't mean the income and expenditure of each and individual people. That is related. Public finance actually related to government. Actually, it is mentioned over there that it deals with the study of revenue and expenditure of the government at the center, state and local bodies. The public authorities have to perform various functions such as maintenance of law and order, provision of defense, production for bringing in economic development, and the performance of this function obviously require large amount of funds which is raised through taxes, fees, fines, commercial revenues and loans. So what is public revenue? Public revenue is nothing but a public income. At least this is one type of income. Revenue generation is the income for the government. This is one of the branches of public finance, and it deals with the various sources from which the state might derive its income. So revenue is very, very important for the government. Actually, based on that, all the wages, salaries, and all the expenditures are made. These sources include incomes from taxes, commercial revenues in the form of prices of goods and services supplied by public enterprises, administrative revenues in the form of fees, fines, etc., and gifts and grants. So all these are the fall in the category of revenue. So difference between public revenue and public receipts. Here we find a new term, public receipts. So public revenue, as already mentioned, includes the income which is not subject to the repayment by the government. But the public receipts include all the income of the government, including public borrowing and issue of new currency. In this way, public revenue is a part of public receipts. So public receipts actually is the addition of public revenue plus public borrowing plus issue of new currency. So objectives of taxes are raising revenue, regulation of consumption and production, encouraging domestic industries, stimulating investment, reducing income inequalities, promoting economic growth, development of backward regions, ensuring price stability. So objective of taxes, though there are several objectives of taxes, among these, raising revenue is very, very important, and the promoting economic growth is very, very important, and ensuring price stability is also an important part of the objective of taxes. Let us move to the next slide. So taxes can be classified into two types, as already mentioned in our earlier lecture, the direct tax and indirect tax. So what is direct tax? A direct tax is that tax whose burden is borne by the same person on whom it is levied. Actually, when common people, let us consider a common people, his income, he is actually carrying the taxes also. Depending on the income of that person, the tax is levied. So the ultimate burden of taxation falls on the person on whom the tax is levied. It is based on the income and property of a person, as already I have mentioned. So let us see what are the examples of direct taxes, like corporation tax, income tax, wealth tax, gift tax, property tax. All these are examples of direct taxes. If we consider indirect taxes, an indirect tax is that tax which is initially paid by one individual, but the burden of which is passed over to some other individual who ultimately bears it. It is levied on the expenditure of a person. So the examples of direct taxes are excise duty, sales tax, custom duties, value added tax. All these are the example of indirect taxes. And on the basis of degree of progression of tax, it may be classified into proportional tax, progressive tax, regressive tax, and digressive tax. So let us find what is proportional tax, what is progressive tax, what is regressive tax, and what is digressive tax. So first start with proportional taxation. A tax is called proportional when the rate of taxation remains constant as the income of the taxpayer increases. In this system, all incomes are taxed at a single uniform rate, irrespective of whether taxpayer's income is high or low. So that is the proportional taxation. That is the fixed rate is followed in case of proportional taxation. The tax liability increases in absolute terms, but the proportion of income taxed remains the same. So whether the income of a person is more or less, that doesn't depend on proportional taxation. Next is progressive taxation. When the rate of taxation increases as the taxpayer's income increases, it is called progressive tax. Taxpayer's income increases and also the taxation is also increases gradually. So this is progressive, that is increasing. Progressive means increasing. In this system, the rate of tax goes on increasing with every increase in income. Regressive taxation. A regressive tax is one in which the rate of taxation decreases as the taxpayer's income increases. This is just reverse of progressive taxation. Lower income is taxed at a higher rate, whereas higher income is taxed at a lower rate. However, absolute tax liability may increase. So this is the case, this is a special case generally followed for special purpose. Now, our next term is digressive taxation. A tax is called digressive when the rate of progression in taxation does not increase in the same proportion as the increase in income. It is increasing, but the rate of increase of rate of proportion of increase or rate of increase is not proportionate with the increase in income. In this case, the rate of tax increases up to a certain limit. After that, a uniform rate is charged. Thus, digressive tax is a combination of progressive and proportional taxation. So, this type of taxation is often used in case of income tax. This is the case of income tax in India as well. So, I repeat, that digressive tax is a combination of progressive tax and proportional tax. So this type of taxation is actually followed in India for the case of income tax of common people. Income exempt from tax. What are the ways that the income exemption can be made? Dividend paid by the companies and mutual fund, insurance proceeds from an insurance company, maturity proceeds of a public provident fund, that is PPF account. If we deposit our money in public provident fund, in insurance company, in mutual fund, then tax exemption may be availed. Deduction from taxable income. There is a law, and according to this law, Section 88 of the Income Tax Act 1961, rebate is there on certain investments. In Section 80C, deductions is there. In Section 80D, medical insurance premium is assured. Interest on housing loan is also the taxable income. So, we may reach to the conclusion. To conclude, we can say that the instrument of taxation is of great significance on increasing the level of economic activity, that is regressive taxation, reducing income inequalities, that is progressive taxation. Actually, in progressive taxation, what we have learned, that when the income increases, the rate of tax also increases. When the income decreases, the rate of tax also decreases. So, the income inequalities thus has been reduced by progressive taxation. And promoting economic growth, that funds could be reinvested. After maturity, the funds can be withdrawn and can be reinvested for the benefit of the owner, and that ultimately promote the economic growth of the country. There is another objective, social welfare objective. Tax payment helps reduce the gap between the haves and have-nots. As it helps in mobilizing the surplus income from the haves and reinvesting them for public welfare, it helps these surplus funds to reach the have-nots. Let us have a quiz. Why not? We should try for a quiz. So public revenue, first question is, public revenue is a branch of, 4 options are there: government finance, public deposit, public investment. So our answer is, right answer is B, that is public finance. Public revenue is a branch of public finance. Next, move to our next quiz. Who gave the concept of 4 canons of taxation? Adam Smith gives the concept of canons of taxation. Who is known as the father of economics? Adam Smith is known as the father of economics. Funds for expenditure on maintenance of law and order, provision of defense infrastructure is raised through, there are 4 options: charity, taxes, shares, and public funding. So the right answer is taxes. That means funds for expenditure on maintenance of law and order, provision of defense infrastructure is raised through taxes. Next question is, objective of tax is to generate government revenue, foreign trade, political campaigns, FDI. The first one is the correct answer, that is to generate government revenue, that is to generate government income. Tax helps to reduce the gap between the dash and dash. We have already learned in our last slide that tax helps to reduce the gap between the haves and have-not. Which of the following is exempted from the tax? Salary, insurance proceeds from an insurance company, proceeds from fixed deposit, none of the above. We have already studied that insurance proceeds from an insurance company is exempted from tax. Here we find the income tax authorities. Income tax authorities are central government, that is income tax, excise duty and customs duty they are handling. State governments also, they are handling with sales tax, VAT, excise and tax on agricultural income. Municipalities, that is local bodies, as already mentioned in our earlier slide, that octroi and house property tax, that is handled by municipality. Total income of an individual assessee. Total income is maybe salary income, that is the basic income, maybe house property, maybe you are having a big house and you have rented the house, that is also your income. Business or profession, maybe you are a salaried person, still you are having a small business or some other small profession, there also you are earning the money. Capital gains, by means of anything, say you are gaining some capital, so that is also taxable income. And income from other sources, there may be some other sources also, that is also the taxable income. So income means some monetary returns periodically received from some definite source. I repeat, income is the monetary return periodically received from some definite source. Assessee is a person liable to pay tax and any other sum of money under this act. Person, according to law, an assessee is a person by whom any tax is payable. Person means not only individual, not only human being. Person means includes an individual, a company, a firm, a local authority also. So these are the references. You may go through that. If you have further query, feel free to ask to my email ID shunipa.roy@gnit.ac.in. Thank you very much.